Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. It must be an election year because all the news flows expound on the strength of the economy, the great job numbers, and the stellar performance of the financial markets. What is there not to like? What is not to like is that it is misinformation. It is hype. That is great for elections, but can be a dangerous cocktail for investors not doing their homework. I want to show you, in as quick a fashion as I can, where you are being misled. To do that, I want to cover the areas outlined here. In a recent CNN poll, 48% of respondents stated they believe the economy remains in a downturn, and only 35% said that they believe that things in the country today are going well. These are atrocious numbers by any measure and are completely at odds with the current mainstream narrative. The disparity between somber economic sentiment and a surprisingly strong headline unemployment rate and gross domestic GDP can be easily explained. The divergence between headline GDP and gross domestic income, or GDI, is staggering. The gap opened up in late 2022 and has grown ever since. GDP is now about $500 billion bigger than GDI. This fact is something I've been talking about for over a year, and it only keeps getting worse the more the U.S. deficit worsens. An exploding deficit, yet the economy is great? How does that work? While GDP suggests a strong economy, GDI reveals a stagnant economy. Both measures used to follow similar patterns and track closely, but as I've pointed out previously, this changed drastically in 2023. While GDP rose 2.5 in 2023, GDI only bounced 0.5%, effectively signaling economic stagnation. According to the Bureau of Economic Analysis, real GDI increased only marginally at 0.5% in 2023 compared with an increase of 2.1% previously. If we use the average of real GDP and real GDI, it increased only 1.5% in 2023, compared with an increase of 2% in 2022. Maybe this is not a recession, but it is certainly a weak economy. In fact, what we are realistically experiencing is stagnation, with the beginning elements of stagflation showing. I like this chart of the Dow Jones Industrial Gold Ratio going back to the 60s. It has made me a lot of money by keeping me on the right side of what is really going on and not the misplaced spin of the day. It identifies the major legs we have experienced regarding stagflation in the 70s on the left, through to the cyclical period of stagnation following the dot-com bubble bursting, through the period of reflation brought to you by quantitative easing, to the post-COVID world and the end of the Great Moderation. For the last 3 years, I have watched the consolidation take the form of a corrective ABCDE triangle fenced in by colliding trend lines. Over the last month, with the major move in gold, it appears the test is complete, and the red monthly bar shows it. The secular period of stagnation since the dot-com implosion will now likely resume. It is one of the reasons we have been talking about gold and specifically integrated gold miners in our weekly newsletter chart deck. This fits with our 2023 thesis paper entitled The Great Stagflation, which laid out this thinking in a lot more detail, which can be downloaded free from the Matasi website. Though the thesis paper talked about the coming debt crisis during the beta drought decade, we had yet to fully experience the full unfolding ramifications of the $6.3 trillion in government deficit spending. This chart gets to where the GDI distortions has gotten us to. We had approximately $62 trillion in global government debt as measured by GDP in 2020, which was supported by $84.96 trillion in debt. 2 years later, the debt is $82 trillion on a GDP measured of approximately $104 trillion. This is $20 trillion of new global debt to grow the global economy by $20 trillion. Are we growing debt or growth? Or are we growing the economy or just debt? GDP measures expenditures, that is, spending driven by debt. GDI measures income, or the other side of the value of the spending. It comes up woefully short. This is the simple misconception that is being used to mislead you today and lead everyone during this election season. How is this showing itself in the economy? And why do the polls read as they do? The unemployment figures actually show weakness if looked at properly. Real wage growth in the past 4 years has been negligible, at 0.7% per year, 4 times weaker than the previous 4 years. Furthermore, the labor participation rate remains below the pre-pandemic level at 62.5%, the same as the employment population ratio at 60.1. Poor real average hourly earnings combined with a decrease of 0.6% in the average work week has resulted in an uninspiring 0.5% increase in real average weekly earnings in the year to February 2024. There is also a weak trend in profits. Everyone is misled by the unprecedented market distortions brought to you by the Magnificent Seven, by their earnings per share, which are a function of how much they are reducing their share outstanding with massive stock buybacks. In 2023's profits from the current production, or that is corporate profits with inventory valuation and capital consumption adjustments, increased by $49.3 billion, compared with an increase of $285.9 billion in 2022, and this according to the BEA. Profits of domestic non-financial corporations increased $66.6 billion, compared with an increase of $247 billion in 2022. This is a very weak trend, though figures indicate that the U.S. economy is performing significantly better than the euro area. Both are still below what expectations should be for the level of deficit stimulus being pumped into the almost lifeless economies. Keynesianism is working against the potential of the United States economy. The accumulated $6.3 trillion deficit of the past 4 years had a negative impact on the economy. Rising taxes and persistent inflation are eroding the average American quality of life. More citizens need to hold more than one job to make ends meet, and the number of multiple job holders has reached a multi-decade record. Gross domestic income proves the economy is stagnant. And if we look at GDP and GDI, excluding accumulation of debt, they show the worst year since the 1930s. How can economies be stagnant with 2.5% GDP growth? Here is the failure of Keynesianism in all its glory. Headline aggregated figures are optically strong due to the accumulation of debt, and unemployment figures are bloated by government jobs disguising a struggling private sector and a weakening purchasing power of the currency. Cheap money is very expensive in the long run, and discontent rises as Keynesianism focuses on increasing the public sector, while the productive economy suffers higher taxes and more challenges to pay the bills. Bills that come with paying for the jobs and services to support over 10 million and increasing undocumented immigrants flowing across our borders like an uncontrolled tidal wave. A tidal wave of unbudgeted, and as yet, because it is election year, with no tax increases to pay for the load on public services at the state and local levels who have no budget nor any plans for it. Want to take a guess at what the deficit spending is going to be to pay for all this? Inflation is a consequence of the misguided increase in government spending and debt, monetization in the middle of a post-pandemic recovery, leading to an aggregate loss of purchasing power of the currency that is close to 24% in the past 4 years. The government is taking in inflation, what it promises in entitlement spending. The result? You are poorer. It is dangerous to blame Americans' discontent on a lack of information. Americans are suffering a prohibitive tax wedge, as well as the hidden tax of inflation, just because the government decided to play the oldest trick in the book, promise free stuff, and print new currency through deficit spending, which makes the allegedly free programs more expensive than ever. The failure of Keynesianism is evident. Sadly, politicians will promise more Keynesianism and present themselves as a solution to the problem they have created. The Fed is making a big mistake by cheering the headline economic figures that come from disguising a private sector recession with a massive increase in public debt and weakening employment figures embellished by temporary jobs and public sector hiring. We are paying for big government to become even a bigger government. Additionally, it is making a mistake by giving dovish signals that make market participants take more risk. There has been no relevant reduction in the money supply if we include the different layers of liquidity injections. Announcing forthcoming rate cuts will certainly make speculative debt rise, but will hardly change the credit demand from the backbone of the economy, small businesses, and families. Since the U.S. government has rejected any calls for normalization, instead added more deficits and debt as if rising bond yields were not a problem, citizens and businesses have already suffered greatly from ongoing inflation and rate increases. As such, the rate cuts will help an already bloated government spending, the zombie corporations that keep access to capital markets. Everyone else will be hurt, both ways, with inflation and lower access to credit. You may think all the above problems are policy mistakes, but they're not. This is the slow process of nationalizing resources. Inflation and artificial money creation through deficit and monetization are a gradual transfer of wealth from real salaries and deposit savings to the government, or what is increasingly becoming, whether planned or unwittingly, a regulatory state. You are basically becoming poorer to sustain an ever-increasing government size. The next time you read that massive deficits and monetary easing are good policies for the middle class, ask yourself why you find it harder each year to pay for goods and services. The mistake made in 2024 will cost the middle class many more taxes, even if the government promises it will be taxes on the rich, the oldest gimmick to raise your taxes. Remember this saying, in capitalism, you get more for less. But as a country moves towards socialism, you get less for more. Does that resonate with what you're seeing? More taxes, persistent inflation, the hidden taxes, and the loss of value of your wages. That is easing for you? A private sector recession with headline economic figures bloated by government debt. This is a perfect recipe for increasing economic stagnation. I started this video with how weak the CNN poll was regarding how 48% of the respondents stated they believe the economy remains in a downturn, and only 35% said that things in the country today are going well. These are atrocious numbers, but actually reflect what people see and experience with their own eyes. It is my sense that both presidential candidates, and I'm not political, I'm an economist, are terribly polarizing candidates taking America either further right or further left. What will solve economic conditions is to take America towards the center of what America is and what built America, what we all agree on. A depolarization of America and a functioning Congress versus a country increasingly directed by executive order and government regulations to get anything done. I hear a former president's voice in my head from over 40 years ago when he spelled out that, and I quote, "The government is not the solution. The government is the problem," end of quote. The next 4 years of his term ushered in some of the U.S. best economic times and policies that fostered them. I also hear another president, 20 years before that, who was the most uniting president in my lifetime, challenging us individually with, and I quote, "Ask not what your country can do for you, but rather what you can do for your country," end of quote. Without America coming together, rather than continuing to fracture, economic stagnation and stagflation is surely ahead of us in an increasing fashion. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems, until such time as no one will take the money or it is simply of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and a global policy paralysis. I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.